CVS stock has an interesting opportunity with its diverse operations to view a patient more holistically by managing both medical and pharmacy benefits, which could lead to revenue and cost synergies for the company long term. That being said, is the stock a buy at current market prices? That's the question I'll answer in this video, evaluating the company's revenue growth over the previous decade, looking at its returns on investor capital over the same time period, and comparing it against its valuation using two different perspectives. First, I'll share with you my proprietary discounted cash flow valuation model, which calculates the fair value of the stock price today. Second, I'll look at the forward price to earnings ratio to determine if the company is trading at an attractive price, looking at it multiple-based valuation. I'll do all that in this short video and let you know if the stock is a buy. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so CVS has done an excellent job growing revenue over the previous decade. The one question mark I will place, or the one asterisk I will place on CVS's revenue growth over the previous decade, is the acquisitions. There's been several acquisitions over the previous decade and longer that's helped the company grow revenue. Without those acquisitions, I don't think the company would have been able to grow revenue by this much over this relatively short amount of time. Its revenue has grown from $37 billion in 2005 all the way up to $371 billion today. If we were to look at just the last decade, it's grown its revenue from $153 billion and more than doubled to $371 billion. So revenue growth has been there for CVS. The ways the company has grown its revenue is the question mark because it hasn't been very effective at its revenue growth. The next metric I wanted to evaluate is the company's return on investor capital. And this is what I mean by the company's revenue growth has not been very attractive or very lucrative. Its return on investor capital has decreased from 8.6% in 2016 all the way down to 3.1%. But that's not all. Not only is the trend declining, which sometimes can be okay if the company was starting off at such a high level that it was inevitable for the return on investor capital to decline because it was unsustainably high. This wasn't a really high level to begin with at 8.6%, and then falling to 3.1%. It's also well below the company's weighted average cost of capital. So this is a big question mark for the company. And the segment I would say that's bringing down the overall company is the retail segment, the physical stores. People much prefer shopping online and having things delivered to their doorstep. Having a physical footprint as large as CVS does, with as many locations as CVS has, is weighing on the company because they're not utilizing these stores effectively. Now, two brick and mortar companies, I can highlight three actually, that are utilizing their brick and mortar stores effectively are Walmart, Target, and Costco. They do a great job of getting people to come into their stores and utilize those stores most effectively. Target and Walmart use the buy online, pick up in store features like buying online and picking up in the parking lot that have become incredibly popular with consumers. Costco limits store development and packs as many customers as they possibly can into one single location. If you've ever gone to a Costco, you've probably got hit in the back of the foot with a shopping cart multiple times during any one trip because there's so many people in every location, there's hardly room to move around. So those strategies have worked well for those brick and mortar retailers in generating sufficient returns on capital, even though they have many, many locations. CVS has not been successful in that regard, and there's no signs of a strategy that will make it successful. So that's a big question mark for investors looking ahead. So now that I've looked at those critical metrics, let me share with you my proprietary discounted cash flow valuation model for CVS Health Corporation. Now, let's start backwards. Let's start with the result, which I calculated these shares to be worth $80.29 each today. Even though I'm taking the present value of all of the free cash flow I expect this business to generate between today and the very, very long run, I'm valuing what the business is worth today. I'm collecting all of the cash flow I expect this business to generate, and I'm bringing it all back to today using the weighted average cost of capital. That WACC is 9.24% for CVS, with a cost of debt of 9.5% and a cost of equity of 7.7%. The company has a relatively low beta of 0.54, given that it's a healthcare company, given that it serves primarily the healthcare market, which is not strongly correlated with the macroeconomy, which makes it less risky because if people lose their job, it doesn't really matter. If you get sick, you need to go to CVS to get the thing that you need to pick up your subscription or prescription, I should say, or to pick up some cold and flu medicine, whatever it might be. You're not thinking about whether or not you have a job or whether or not you just got a raise. You're thinking about your illness and you're thinking about what you need to do to cure yourself to make yourself feel better. And so that makes healthcare companies less correlated with the macroeconomy, which is an attractive characteristic for investors because most of us in our portfolio, we have a bunch of stocks, we have several stocks, and many of them are correlated with the economy. So if there's a recession, the rest of our portfolio will likely experience a decrease. But if we have a healthcare stock included in that portfolio, that healthcare stock will not experience a similar dramatic fall from their highs because of what's going on in the macro economy. So that's something that investors like with healthcare stocks. And I also like that feature as well. Right. So I shared with you, I like to look at valuation on more than one perspective. And for CVS, I'm going to look at the forward price to earnings ratio. And I'm getting this data from finchat.io. It's my preferred data source. If you use my affiliate link in the description, you'll get a 2-week trial as well as a 15% discount off this service. So looking at it on a forward price to earnings ratio at 10.14, it also looks undervalued. And remember when I shared with you my intrinsic value of $80, what I had right next to it was the current market price of $62, which also showed that the stock is undervalued according to the current market price. So even though there are many, many risks associated with CVS, most notably, of course, the current administration and, almost every administration going back 2 decades has looked into healthcare in the United States and changing the way healthcare is delivered to citizens in the United States. That's a risk, as well as the risk with the retail footprint, the declining foot traffic, which I don't suspect to end anytime soon. But despite those factors, I believe those are already priced into CVS stock. That's why you can get CVS stock at such a low price because of those risks I highlighted earlier. So I still think that the risk versus reward is worthwhile, and I have rated this stock as a buy.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.